Welcome to the deep dive. Today, we are wrestling with a company that has, well, just experienced one of the most volatile and, frankly, dramatic transformations I think we've seen in recent market history.
Oh, absolutely.
We're talking about Bitmine Immersion Technologies, ticker BMNR.
When you say dramatic, I mean, that's almost an understatement. We're talking about a total structural re-engineering of the entire business model.
Right.
In the last year alone, BMNR stock has traded between, what was it, $3.92 and $161.
$161.
Exactly. That's not the kind of volatility you can blame on a bad earnings report. That is a fundamental identity crisis and then a complete rebirth.
A rebirth is the right word. We're talking about a company that went from being, a small, capital-intensive, energy-guzzling mining operation.
A traditional physical infrastructure business.
Yes, exactly. And it transformed into a $13.2 billion digital asset treasury in less than 6 months.
It's an insane pivot. And because of that, it's attracted some of the biggest names in high-growth tech investment.
Which really forces us to ask this profound analytical question, and this is really the heart of this deep dive for you today. Is BMNR a legitimate next-generation value vehicle? The modern version of a diversified Buffett-style holding company, just built on digital assets.
Or is it something else?
Or is it a spectacular house of cards built entirely on volatile asset hype and, frankly, some very aggressive financial engineering?
That is the perfect way to frame it, because the data immediately throws up a huge contradiction.
It really does. And we should say, we're synthesizing all of our sources today, which are current as of November 14th, 2025.
A very significant bid.
Incredibly significant. The stock price closed at $40.55 on this specific date because that is the very day the company announced its new finance-focused CEO.
And here is the core conflict. This is the one thing you need to hold in your mind for this entire analysis.
Okay.
BMNR has publicly reported its holdings, its net asset value, or NAV, and that totals $13.2 billion.
$13.2 billion.
Right. And that figure represents 3.505 million ETH tokens, 192 Bitcoin, and about $398 million in unencumbered cash.
So that's what's in the vault, so to speak.
That is what is in the vault. However, its current market capitalization, which is the price the market is putting on the entire company, is only $11.68 billion.
Wait, so that means if you divided the market cap by the NAV, that's less than 1.
Exactly. The calculated price to NAV is approximately 0.88.
Okay.
This implies the stock is trading at roughly a 12% discount to the liquid, realized value of what it says it owns.
So that's the paradox. How can a stock that seems so overvalued on some metrics be, deeply discounted on the only metric that seems to truly matter?
That is the analytical puzzle we have to solve today.
Let's do it. We are diving deep into the strategy, the management, and the financials that created this whole situation, starting with the pivot itself.
Let's get into it.
Part 1, chapters 1 to 3, business, management, and financials. Chapter 1, business understanding. To really get BMNR today, we have to tell the tale of two completely different companies. I mean, there's the old BMNR before June 2025, and then the new BMNR that just sort of emerged after.
They couldn't be more different.
So what was that legacy business actually like, based on, say, the 10Q filing from back in May 2025?
The old BMNR was, it was a textbook capital expenditure business. A tiny microcap operation focused on the low-margin, high-energy world of crypto mining.
So lots of hardware, lots of electricity bills.
Out of it. Their primary operation was running a hosting center for Bitcoin miners, and they often used immersion cooling technology just to maximize efficiency.
Okay.
They mined Bitcoin for their own balance sheet, and they also offered a mining-as-a-service product where they would sell or rent equipment and hosting to other people.
So a classic logistics and operations business.
100%. Highly dependent on hardware imports, energy prices, and just operational uptime.
And then came this radical break, the one that just ripped the company free from that legacy. June 30, 2025. That's the date.
That's the critical date. Tom Lee, a very well-known Wall Street strategist, co-founder of Fundstrat, he was appointed chairman.
And then everything changed.
The old business identity just evaporated. It transformed into a digital asset treasury, or a debt holding company.
So how does this new, purely financial model actually generate value? What are they doing now?
It's a complete philosophical shift. They went from focusing on, kilowatt hours and cooling systems to focusing solely on the balance sheet.
Right.
And they operate now under 3 primary value streams. First is just asset appreciation.
It's a simple one.
The simplest one. Their main business is just accumulating Ethereum ETH and benefiting from its long-term price increase. Their success is now completely tied to the ETH supercycle thesis.
That makes them a proxy investment. But they argue they're more than just a passive proxy, right?
They absolutely are, and this is a crucial distinction. The second value stream is staking yield.
Okay, explain that.
Unlike a simple ETF that just holds assets in, say, cold storage, BMNR is an operating C Corp. They actively stake their enormous holdings, that's 3.5 million ETH, to participate in the Ethereum network security.
And they get paid for that.
They get paid for that. They earn rewards in the form of more ETH. This creates an active compounding yield or profit on their massive asset base.
What does that yield typically look like?
Usually around 3 to 5% annually, and that is added directly back into their total ETH count. It just grows.
So they're not just sitting on 3.5 million ETH. That 3.5 million ETH is actively printing more tokens for them every single day.
That's the model.
Can you put that in dollar terms just to give us a sense of the scale here? If we take the low end of that, say a 3% annual yield, what does that mean?
Well, if the 3.5 million ETH is worth, let's say, $12.76 billion, a 3% yield means they generate roughly $382 million worth of ETH per year.
Wow.
And that's just for performing network security duties. It's pure compounding asset growth without the expense of selling any tokens. It's the structural advantage they claim over passive funds.
Understood. Now, what's the third piece? The most aggressive part of their strategy. The one that MicroStrategy really pioneered.
That's the reflexive capital raising. Chairman Lee has been very explicit about this playbook.
So how does it work?
The thesis is that if the stock starts trading at a premium to its net asset value, so PNAV is greater than 1.0.
Right, if the market values them higher than their holdings.
Exactly. Then the company can issue new shares, use the cash to buy more ETH, and because they're selling stock for more than the assets are worth, it becomes an accretive event.
So it theoretically grows the value per share for existing holders.
It's a self-feeding growth mechanism, a virtuous cycle, provided the market stays enthusiastic enough to maintain that premium.
Okay, so what drove this incredibly dramatic pivot? Was it just opportunism, capitalizing on rising crypto crises? Or were there external pressures forcing their hand?
It was a strategic masterstroke, and it was driven by these powerful, almost oppositional regulatory forces. First, there was a very strong push away from the old operational model. The U.S. imposed tariffs of 2025.
Yes.
Those tariffs just slammed the capital-intensive mining sector. We're talking duties of 24% to 46% on essential ASIC mining hardware imported from Asia.
Which is the backbone of that whole industry.
It is. And that kind of duty structure must have just annihilated the profitability of a low-margin business like theirs.
I can't imagine how they'd survive that.
It made the legacy mining business economically unviable, almost overnight. The hardware cost skyrocketed. It effectively taxed their operations out of existence in the U.S.
So management saw the writing on the wall.
They had a choice. Continue operating a dying hardware-dependent business or pivot. Hard.
And at the exact same time, there was this powerful pull towards the new model driven by legitimization.
Precisely. We saw the passage of the Genius Act and the SEC's Project Crypto initiative in 2025.
Right.
And these initiatives started creating a clear, legitimate, institutional-grade regulatory framework for digital assets here in the U.S.
Which was the missing piece for big money.
It was. Before this, large funds were terrified of counterparty risk, custody confusion, unclear tax implications. It was the Wild West.
So what specifically did the Genius Act and Project Crypto do that made these huge institutions feel safe enough to throw billions of dollars at a company like BMNR?
It wasn't just vague encouragement. It was about operational clarity.
Okay.
The Genius Act formalized rules around the custody of digital assets. It specified required security standards, liabilities, and that significantly reduced counterparty risk for massive funds.
It gave them a rule book.
A rule book. And critically, it also provided clear tax treatment for staking rewards. It confirmed how that compounded yield would be recognized, which removed a major accounting headache.
And Project Crypto.
That was the SEC signaling that it was actively looking for compliant entities to act as bridges between traditional finance and this decentralized world. BMNR essentially became an early poster child for a compliant asset holding under this new framework.
So the pivot was a defensive masterstroke. They escaped a bad environment and ran straight into a good one.
A rapidly deteriorating one into a newly legitimizing favorable one, yes.
So let's define the new product again. If BMNR is a holding company, what is it actually selling to the public besides just the ETH itself?
The primary product is BMNR stock.
The stock is the product.
The stock is the product. It's marketed as a highly liquid, publicly traded proxy for holding Ethereum. And management argues it offers clear advantages over, say, a spot ETH ETF or just holding the token directly.
Like what?
Well, they offer active balance sheet management, staking for yield, the option to issue debt against their assets, and most importantly, the ability to grow the asset base through those accretive capital raises in ways an ETF is simply legally restricted from doing.
So you're betting on the asset and on the capital allocation skill of management.
That's the pitch.
And they have scaled this incredibly fast. They're now the #1 corporate Ethereum treasury globally and the second largest crypto treasury overall, right behind MicroStrategy.
Which requires a very powerful, very ambitious vision.
And that vision is the alchemy of 5%.
Right. This is both their marketing slogan and their aggressive strategic goal, acquiring 5% of the total circulating supply of Ethereum.
And where are they now on that goal?
As of their November reports, their 3.5 million ETH puts them at about 2.9% of the total supply. So they're a little more than halfway there.
What's the strategic significance of hitting 5%? I mean, why is that number so magical? Is it just a big round number?
No, it's not arbitrary at all. It's the whale strategy. It's a play on network power law benefits.
Okay. What does that mean in this context?
In the Ethereum proof-of-stake ecosystem, if a single corporate entity holds 5% of the total staked ETH, they kind of transcend being just an investor. They become a strategic player with outsized network influence.
How so?
This scale gives them a disproportionate voice in crucial network validation decisions, potential governance votes, and institutional adoption roadmap discussions.
So the alchemy is the transformation.
The alchemy is turning a simple quantity of tokens into fundamental strategic network power that creates value beyond just the market price. That is the long game they are selling to investors.
Okay, let's look at the competitive landscape. MicroStrategy, MSTR, is the obvious peer they're copying, but for Bitcoin. What about direct competition in the Ethereum treasury space?
Their closest direct competitor is a company called SharpLink Gaming, ticker SBS, which executed a similar kind of pivot.
Okay.
But BMNR's scale advantage is already just overwhelming. SharpLink holds about 861,000 ETH, with an NAV of around $2.94 billion.
And BMNR?
BMNR holds 3.5 million ETH, with an NAV of $13.2 billion. They're more than 4 times larger.
So the scale war seems essentially over before it even really began. BMNR is the dominant player.
It is, and that scale creates a massive barrier to entry, a moat, if you will.
How?
BMNR stock has phenomenal liquidity. It trades an average daily volume of $1.6 billion.
1.6 billion.
To put that in perspective, that volume ranks them as the 48th most traded stock in the entire U.S. market. Large institutions demand that kind of deep liquidity to deploy hundreds of millions of dollars efficiently. So BMNR just becomes the default low-friction choice for major funds who want regulated, high-volume ETH exposure.
But I have to challenge you on this moat. I mean, couldn't a far larger financial institution, a big bank, a traditional asset manager, decide to pivot and raise, say, $20 billion overnight and just instantly wipe out BMNR's scale advantage?
That's a critical challenge.
What protects them beyond just current liquidity?
The protection relies on 2 things. First, the first-mover advantage in the compliant institutional space, thanks to Project Crypto.
Yeah.
BMNR got their structures approved and attracted that initial group of high-profile funds like ARK and Founders Fund before their competitors could.
And the second thing?
Time to deploy. Even a massive traditional fund needs months, if not quarters, to acquire 3.5 million ETH without dramatically spiking the market price against themselves. BMNR already holds the assets. They are fully deployed. A new entrant faces a huge amount of deployment friction, so their first mover status and high liquidity make it nearly impossible for competitors to catch up organically.
So the barriers to entry aren't just technology anymore. It's capital, regulatory acceptance, and the frictionless nature of their stock.
Exactly.
Chapter 2, management evaluation. The fundamental thesis of a holding company, really, is that management's sole job is capital allocation.
It is the entire investment thesis.
So evaluating the leadership is paramount. And the changing of the guard at BMNR was swift and decisive. It marked a very clean break from the past.
Oh, yeah. We saw the formal exit of the old guard today, November 14th, 2025. Jonathan Bates, who is the CEO of the legacy mining business, he resigned. He received a $1,912,500 cash severance.
And that action just removes the operational baggage. It fully solidifies the pivot to a financial entity.
Completely. And now you have the 2 key figures, the visionary and the executor.
The visionary being Tom Lee.
Right. The chairman since June. He's the architect, the strategic mind, and the public face. As the co-founder of Fundstrat, he brings a massive amount of Wall Street credibility and media savvy.
He's the one constantly communicating the Alchemy of 5% strategy.
And championing the whole digital asset supercycle.
Yes. And then there's the new guard, the CEO appointed today, November 14th, Tsang. His background really confirms this absolute shift in strategic focus.
It really does. Mr. Tsang is 56.
Yeah.
And he comes from a deep background in finance and capital markets. Specifically, a venture capitalist and a SPAC executive.
That's the signal.
That is the signal. BMNR needed a capital allocator, not a logistics manager. His job, reporting to Chairman Lee, is strictly balance sheet management, optimizing staking, and executing the aggressive ETH acquisition strategy.
So the leadership now fully reflects the mission. They're a finance company that just happens to hold digital assets.
That's it.
Now let's talk about their clear, non-ambiguous, two-step capital allocation playbook, starting with the constant raising of cash.
Step 1 is raise cash. They execute these massive share issuances, typically through registered direct offerings aimed squarely at large institutional players.
And we have some recent examples of that.
2 key ones. First, the $182 million sale of shares to ARK Invest back in July. And second, an even larger $365 million offering in September.
Those are gargantuan capital raises for a company that was a microcap shell just 6 months ago.
They are.
And then step 2, immediately deploy 100% of those proceeds.
Correct. Buy assets. 100% of the net proceeds from these raises go directly to acquiring more ETH. This is why the model is called the dilution machine.
Right.
They are actively, aggressively, and constantly issuing new shares.
Okay, let's make that dilution concrete for you as an investor. If they executed those 2 massive raises, $182 million and $365 million, how severely did that impact existing shareholders?
It was substantial. When you look at the share count, the total shares outstanding just exploded from the legacy count to where it is now in just a few months.
So for that September raise?
For that specific $365 million raise in September, they issued approximately 9 million new shares at an average price of around $40.
Okay.
Given the total float was around 287 million shares before that offering, that single action resulted in immediate dilution of about 3.1%.
And when you combine all the raises?
When you combine the series of raises throughout Q3 2025, the total dilution is closer to 10% to 15% in a very short period.
So the investment thesis then is a direct bet that the value of the ETH they acquire has to appreciate by more than the dilutive cost of the new shares they issue.
Yes, it's a high-risk bet. You're accepting guaranteed dilution for non-guaranteed asset appreciation.
It demands relentless, exponential ETH appreciation just to maintain the NAV per share, let alone grow it.
Exactly. And this differentiates BMNR from virtually every other growth stock, which would typically use share buybacks to reduce dilution. BMNR uses dilution as its core growth engine.
We have to address the issue of transparency and management integrity now, which brings us back to Chairman Tom Lee and his outside interests. The company offers exceptional transparency on assets, but there's a clear red flag on the governance side.
On the transparency front, they do deserve credit. The press releases detailing the exact ETH, cash, and even their moonshot holdings, like that $61 million stake in 8Co Holdings, are frequent and granular. Investors know exactly what they own.
But that conflict of interest regarding Fundstrat is just unavoidable.
It is a bright red flag that demands critical scrutiny from any investor.
Let's lay out the facts.
Fact. Thomas Lee is chairman of BMNR, tasked with promoting the company's value. Fact. He is the co-founder and head of research at Fundstrat Global Advisors, a research house whose brand relies on its independence.
And fact number 3.
Fact. BMNR's own corporate press releases explicitly quote Fundstrat data to support their bullish narrative. For example, citing Fundstrat analysis of the stock's $1.6 billion average daily dollar volume to boost the liquidity narrative and attract institutions.
Wait, if Tom Lee's own firm is cited in the company's press releases to promote the stock's liquidity, isn't that basically using the credibility of his private research house to pump BMNR?
It's the right question to ask.
Why hasn't this triggered an investigation or some kind of activist investor pushback on governance?
It creates a self-reinforcing, closed-loop hype machine. The company's own leadership is leveraging their private data to support the public narrative of the company they lead.
And the pushback.
It's slow because the pivot has been so wildly successful so far. It's brought in capital, it's rocketed the stock price. The immediate financial success is overshadowing the governance risk, for now.
But for a critical investor.
For a critical investor, this conflict creates significant key person risk. If Tom Lee were to leave, or if Fundstrat's research objectivity were severely questioned, the entire credibility narrative that BMNR relies on could just collapse, regardless of what assets they hold.
It's a structural conflict that's being ignored because the market is so enthusiastic right now.
For now, yes.
Chapter 3, Financial Health. This chapter is really the key to navigating the analytical traps in this stock. And we have to reiterate the warning. A traditional 5-year financial analysis of BMNR isn't just irrelevant, it is dangerously misleading because of that June 2025 pivot.
Absolutely.
You have to look at the legacy shell and the real holding company as two separate things.
Let's start with the ghost of the past. The legacy financials. This is the old mining company as of May 31, 2025. This really shows us the scale of the shell that the institutional investors actually bought.
So what were the financials of that old mining shell?
Analytically insignificant. I mean, fiscal year 2024 revenue was a paltry $3.31 million.
Tiny.
In the quarter ending May 31st, 2025, they posted a net loss of $622,760. That's a net profit margin of negative 30%.
And the balance sheet?
On the balance sheet side, they were debt heavy. They had $5.39 million in total liabilities against just $2.88 million in total equity. That's a high debt-to-equity ratio of 1.87.
So the data just confirms they acquired an unprofitable, small, and debt-laden public listing. This data gives you zero actionable insight into the company's current value.
Correct. The only use for that data is confirming that the current market cap of $11.68 billion is built entirely on the new asset model, not the old operating results.
Okay, so let's look at the real financials. Based on the last public disclosure on November 9, 2025, this is the only balance sheet that matters.
Right.
And that balance sheet looks like this. Total holdings, or net asset value, NAV, of $13.2 billion.
And the breakdown is, the core is $12.76 billion in ETH. That's 3,505,723 tokens. They also hold $398 million in cash, plus a small stake in Bitcoin, and that's $61 million in moonshot holdings.
It's fundamentally a liquid asset fund.
It is.
Okay, let's address the valuation traps that mislead most cursory investors. First up, the price to earnings, or PE ratio.
BMNR has a trailing PE ratio of negative 12.7. This metric is completely decoupled from current reality. Since the company operates at a loss, and its value is driven by the appreciating value of its non-operational assets, the PE ratio is entirely useless for valuation. You should just discard it immediately.
Okay, now for the second, and far more deceptive, trap, the price to book, or PB ratio. Look up BMNR on any financial screen today, and you'll see these astronomical PB ratios, sometimes over 4,000x.
And that just screams the most overvalued stock in history.
Right.
And this is the most critical analytical point. Those numbers are technically accurate, but analytically meaningless.
Why? What's going on there?
Book value is based on historical accounting costs. We know the total equity, the historical book value of that old shell, was only $2.88 million as of May 31st.
So if you take the $11.68 billion market cap and divide it by that tiny $2.88 million book value from the past, you get that ridiculous 4,000x multiple.
Precisely. The PV ratio is an accounting ghost. It simply highlights the total disconnect between the company's accounting past and its current asset market value.
So the only valid metric that actually matters,
the one that accounts for the reality of the asset holding business model, is the price to net asset value, PNAV.
Let's run that PNAV calculation one more time, just to confirm this central paradox.
Market capitalization, the price, is $11.68 billion. Net asset value, the value, is $13.2 billion.
Yeah.
So $11.68 billion divided by $13.2 billion equals 0.88.
So BMNR is simultaneously one of the most absurdly expensive stocks on an accounting basis, 4,000x PB, and one of the most discounted on a liquid asset basis, trading at a 12% discount.
Yes.
Why does this 12% discount even exist? If the assets are so liquid and transparent, why aren't arbitrageurs just buying the stock until the price equals the NAV?
That 12% discount is the market rationally pricing in the structural risks inherent in the C corporation structure, even with liquid assets. We see similar discounts in closed-end funds or, historically, even in a holding company like Berkshire Hathaway.
So what are those reasons?
3 main reasons. First, liquidation uncertainty. Even though the assets are liquid ETH, there's no guarantee. Management will just liquidate them and distribute the cash to shareholders at the NAV price. An ETF is mandated to do that. The MNR is not.
So management could make bad decisions.
They could make bad allocation decisions, use the cash inefficiently, or liquidate ETH at an unfavorable time.
Okay, what's the second reason?
The tax drag. When ETH appreciates, BMNR is a C Corp and has to pay corporate capital gains tax when it sells the asset.
Right.
The shareholder then pays a second layer of tax on dividends or when they sell their stock.
A double tax.
Right. Holding ETH directly or via a passive vehicle might offer a better single-layer tax structure, justifying a discount on the stock price relative to the asset value.
And third is the dilution risk we talked about.
Exactly. Investors are pricing in the risk that management's constant dilution machine will erode the NAV per share over time, even if the total NAV grows. The 12% discount acts as a perpetual risk premium for those structural uncertainties.
And arbitrage is hard because their whole model is the opposite of a buyback.
Right. The typical mechanism for closing this discount share buybacks or tender offers is explicitly off the table for BMNR. They're focused on capital raising, not capital destruction.
That distinction is incredibly important. You wouldn't run a discounted cash flow or DCF model on a gold vault?
That's the perfect analogy. DCF fails because this company isn't selling a product, it's a vault. Its value is immediately liquid and realized, not based on future operational profitability.
So the intrinsic value is simply?
We estimate the intrinsic value to be $13.2 billion based on the liquid value of its holdings. The valuation hinges entirely on the market's willingness to close that 12% discount to NAV.
Okay, let's pause here. We've just navigated one of the strangest financial paradoxes in the modern market, moving from 4,000 XPB to a 12% discount to NAV. We've confirmed the paradox, but now we have to ask, who believes in this math and who is betting against it? Let's take a quick pause before diving into the market sentiment that drives this extreme volatility.
And before we continue, we need to ask you to do one thing. Like and subscribe to Stock Analytics AI.
And a quick note, for those of you who want instant access to more reports just like this, for $4.99 free, you get 500+ deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives.
We've established the foundation of BMNR's financial reality. Now we shift our focus to the market forces fighting over that 12% discount.
Part 2. Chapters 4 to 7. Market sentiment, ownership, risk, and final conclusion. Chapter 4. Market sentiment. So Wall Street seems almost universally optimistic about this pivot. What is the analyst consensus looking like right now?
The analyst community has fully bought into the asset treasury model. The consensus one-year price target is $75.
$75.
Yep. And the target range goes from a high of $90 down to a low of $60.
So even the most bearish analyst on record is suggesting a 48% gain from the current price of $40.55.
Yeah.
That is some powerful conviction that the NAV discount is going to close and probably turn into a premium, much like MSDR.
It confirms that analysts have completely dismissed those legacy PB metrics, and the media narrative has only amplified this.
How so?
Well, the stock's 500% surge right after Lee's appointment established the core narrative, the MicroStrategy of Ethereum.
Right, that's the catchphrase.
And the constant flow of announcements about their growing ETH holdings just feeds the bull frenzy. It suggests they're on this unstoppable path to the alchemy of 5%.
That kind of rapid movement from under $4 to over $160 is a roller coaster. For you, the listener, who maybe missed that initial jump, does that price action alone signal extreme caution, regardless of the NAV discount?
It absolutely signals extreme caution. This stock doesn't trade on marginal news. It trades on belief and momentum. High volatility means high risk.
But the bulls would argue.
The bull thesis argues that the underlying driver, that 12% discount, provides a rational floor that didn't exist when the stock was soaring at $161. It allows for a safer entry point today. But that floor is being heavily contested by the bear case.
So who is betting against this high-flying story, and how deeply capitalized are they?
The short interest gives us the key counterpoint. Short interest stands at an elevated 10.26% of the free float.
10%. That's significant.
It is. This represents a large, well-capitalized group of bearish investors actively betting on the stock's collapse. They're not simply hedging, they are fundamentally rejecting the sustainability of this business model.
Let's dissect that bear thesis. What are the short sellers actually betting on when they take that 10.26% position?
They're betting on three structural failings. The first is the crypto winter scenario.
A market crash.
A market crash. They believe the underlying asset Ethereum is fundamentally overvalued and that a severe market correction or crypto winter is imminent. BMNR, with its 100% concentration in ETH, would crash harder than the asset itself because of leveraged sentiment and a lack of diversification.
Okay, what's the second structural bet they're making?
That's the hype fade and governance failure bet. Short sellers are arguing that the Tom Lee hype and the Alchemy of 5% narrative are overblown and will fade, causing the current market price to fall below the NAV.
And the governance issue.
They're also anticipating that the fund strat conflict or some other governance issue will eventually result in a crisis of confidence, destroying the credibility they need to raise future capital.
And the third bet is the most fundamental challenge to BMNR's whole operational model, the dilution trap.
The short sellers are betting that the company's business model of constant, massive share dilution will eventually overwhelm market demand and crush the per-share value for existing investors.
Can you trace that risk for us?
Sure. Even if BMNR buys, say, $500 million in ETH, if they issue shares that dilute the total share count by 5%, they have to generate more than 5% in value after tax and transaction costs just to justify the trade.
And the bears don't think that's sustainable.
The bears believe the dilution machine is a short-term pump that guarantees long-term per-share value erosion.
So you have high short interest fighting a powerful bull narrative that's based on this NAV discount. That creates extreme volatility.
It creates a dangerous powder keg. If BMNR starts successfully closing that 12% discount, or if ETH spikes, the bears are forced to quickly buy back shares to cover their position.
A short squeeze.
A short squeeze, which pushes the price violently higher. However, if the dilution thesis prevails or if ETH crashes, the downside is just as severe.
Looking at the technical confirmation, the price action itself seems to support the bull's case of a fundamental shift.
Technically, the uptrend is confirmed. The 200-day moving average is around $12.50. The current price of $40.55 is more than 3 times that long-term average.
So that's strong technical confirmation.
It is. It confirms that the market recognizes the fundamental strategic break that was initiated back in June and is riding a sustained, powerful, long-term uptrend, regardless of the short-term noise.
Chapter 5. Ownership structure. BMNR has 261 institutional owners, but, the sheer quantity isn't really the story here. It's the quality and the type of institutional owner that really defines the investment thesis.
That's right.
So who are the whales backing this strategy?
This is a premier group of high-conviction, growth-oriented capital. The single largest and most prominent institutional shareholder is ARK Investment Management, led by Cathie Wood.
Okay, a big name.
ARK opened a massive $387.9 million position in Q3 2025, acquiring over 7.4 million shares.
And they were key participants in the dilution machine itself, weren't they?
Absolutely crucial. ARK's position included a $182 million direct investment.
A direct investment.
Meaning they actively bought shares directly from the company to fund BMNR's ETH purchases. They are not passive open market buyers. They're actively underwriting the capital allocation strategy.
That demonstrates the highest level of conviction.
It does.
Who else is on this institutional roster, particularly from the venture capital world?
You also find a who's who of high-growth technology in crypto venture capital. We're talking about Founders Fund, Peter Thiel's firm Pantera, Kraken, DCG, and Galaxy Digital.
So these are not your traditional conservative value investors.
Not at all.
If an investor is considering BMNR, what does this ownership structure tell them about the risk profile of the company?
It tells you everything you need to know about the expected return profile. If you were looking for a conservative, stable, value-oriented investment, you'd be looking for Warren Buffett clones. This is not that profile.
This is a different kind of investor.
This ownership structure, Wood, Thiel, Pantera, this is the Shark Tank of aggressive, high-conviction, exponential growth investors.
Their historical investment style is focused on disruptive moonshot bets, not predictable cash flow.
Correct. Buying BMNR means you are aligning yourself with the highest risk, highest upside crypto supercycle thesis of these groups.
So you're betting on exponential returns.
And you accept the high volatility, the high dilution risk, and the lack of diversification that comes along with that bet.
Chapter 6, Risk Assessment. BMNR really represents extremes on both sides, which makes a structured SWOT analysis pretty essential to logically weigh the pros and cons. Let's start with the overwhelming strengths that justify all this enthusiasm.
S1, asset value. The most powerful current argument is that 12% P/NAV discount, the 0.88. It implies the company's liquid holdings alone are worth more than the current market price.
And their market position.
S2, market dominance. Being the #1 ETH Treasury and the #2 global crypto treasury gives them an undeniable first-mover advantage and a competitive moat built on scale and liquidity.
The management and backers also provide some operational strengths.
Absolutely. S3, Elite backing. Having A-list institutions like ARK and Founders Fund provides crucial credibility and a constant, rapid source of capital for future raises.
And the vision.
S4, visionary leadership. Strategy is clear, the alchemy of 5%, and it's driven by the high-profile media savvy of Tom Lee, which gives it a strong narrative edge. And finally, S5, liquidity. That $1.6 billion average daily volume makes it easy for institutions to get in and out.
Okay, now for the weaknesses, which feel very structural given the business model.
They are W1, asset concentration. This is the biggest weakness, the ultimate black swan risk. The entire enterprise is 100% dependent on the highly volatile price of a single, non-diversified asset, Ethereum.
And there's no hedging.
No hedging mechanism built into the model, W2, the dilution model. The inherent business requirement for constant, massive shareholder dilution to finance growth creates persistent long-term pressure on the NAV per share.
And we can't forget the governance concerns.
Right. W3, conflict of interest. The potential key person risk tied to Tom Lee and his conflicted relationship with Fundstrat poses a significant issue for corporate governance purists. It could be an anchor if market sentiment turns sour.
And the legacy business?
And W4, legacy drain. Even though the pivot is complete, there's always a chance the unprofitable legacy mining shell still contains some latent operational liabilities or unmanaged debt that could unexpectedly become a cash drain.
Moving on to opportunities. What could accelerate the story beyond just simple ETH appreciation?
01. Executing the alchemy of 5%. If they successfully hit that 5% goal, they gain that projected network influence and power law benefits, which could generate strategic value far exceeding just the token price.
The alchemy realized.
Exactly. 02. Staking yield compounding. The ability to generate a 3% to 5% compounded return by generating yield on 3.5 million ETH is a massive advantage over passive ETFs. It leads to exponential asset growth.
And the macro regulatory tailwinds.
03. Favorable regulation. The Genius Act and Project Crypto are actively legitimizing the market, positioning BMNR perfectly as a secure, listed bridge for traditional financial institutions who still can't hold tokens directly.
And one more?
04. Broader tokenization. Chairman Lee has actively promoted the broader tokenization of real-world assets on the Ethereum network. If that trend accelerates, it massively increases the utility and value of your core holding.
Finally, the threats. What are the major macro dangers here?
T1. Asset crash. The primary existential threat is a severe crypto winter, leading to a catastrophic drop in the ETH price. That could potentially take the company below its cash value.
And regulators could change their minds.
T2. Regulatory reversal. A hostile new U.S. administration or a legislative reversal that undermines the Genius Act or Project Crypto would just crush the entire institutional acceptance thesis.
And the bears?
T3. The bear case prevails. The large, capitalized 10.26% short interest successfully exploiting the dilution risks, forcing a sharp correction.
Let's analyze how the current macro environment is either helping or hurting the BMNR thesis.
Right now, the macro environment is a massive tailwind. It's very supportive of the bullish institutional investment.
How so?
We're currently in a Fed easing cycle. The policy rate was recently cut to a target range of 3.75% to 4.00%. The benchmark 10-year U.S. Treasury yield is low, around 4.13%.
And low rates historically diminish the attractiveness of fixed income.
Exactly. This dovish monetary policy pushes institutional investors out onto the risk curve to find better returns. That excess capital flows directly into risk assets, including high-conviction growth stocks and crypto proxies like BMNR.
So a major threat would be a reversal.
A sudden reversal back to a high-rate tightening environment would suck liquidity out of the market and severely damage the BMNR narrative.
We talked earlier about the geopolitical threat of those U.S.-imposed tariffs. How does that validate the current strategy?
It's the ultimate validation. The U.S.-imposed tariffs of 2025, with those massive duties on mining hardware, were an existential threat to the legacy business.
Right.
By pivoting entirely to an ETH Treasury model, which is purely financial, non-industrial, and not dependent on imported hardware, BMNR completely neutralized this geopolitical threat. It wasn't just opportunism. It was brilliant, necessary strategic management to escape a regulated death sentence.
Chapter 7. Conclusion. Okay, let's synthesize these extreme findings for you. What is the core appeal, the bull case, that Cathie Wood and Peter Thiel are betting on?
The bull case is this. It's a clear asset-based value play, trading at a 12% discount. That 0.88 PNAV to its liquid holdings.
A margin of safety.
A calculated margin of safety, coupled with the leveraged upside of Ethereum, an asset that is rapidly gaining regulatory legitimacy and institutional acceptance.
And it's led by a strong team.
It's led by a finance-savvy team and backed by the highest conviction tech growth investors who provide credibility and constant capital. They see that 12% discount as just a temporary arbitrage.
Conversely, what's the core risk, the bear case, that those aggressive short sellers are banking on?
The bear case argues that the 12% discount is not a historic value opportunity, but a rational trap.
A rational trap.
It's the market correctly pricing the extreme volatility, the non-diversified asset risk, the tax drag, and the fundamental lack of shareholder return mechanisms, like buyback.
And the dilution machine.
The dilution machine model and the conflicted leadership pose long-term solvency questions regarding per-share value, which is why that short interest remains so aggressively high. They see the price eventually plummeting when the next crypto correction inevitably hits.
Let's restate the valuation one last time to really drive this point home for everyone.
Traditional metrics are useless here. The DCF based on legacy operations values the company at 0.34 cents per share, irrelevant. The price to book is astronomically high, an accounting ghost. The true intrinsic value is the net asset value, NAV, of $13.2 billion.
And the current market cap of $11.68 billion is trading at that 12% discount to NAV. So the entire investment really hinges on two fundamental questions that you have to answer.
Yes. The investor has to answer. First, will the underlying asset, those 3.5 million ETH tokens, continue to appreciate over time, validating the mass accumulation strategy and the immense risks?
And second,
can the management team of Tom Lee and Tsang successfully execute their growth strategy, consistently increase the NAV per share despite the dilution, and convince the market to not only close that 12% discount, but to trade at a premium, as MicroStrategy often does for Bitcoin exposure?
that is the bet. The value arbitrage versus the structural risks.
And here is the final provocative thought we'll leave you with. The entire enterprise hinges on whether BMNR can successfully convert its massive quantity of ETH assets into strategic power, the Alchemy, before the necessary shareholder dilution model destroys the per-share value.
Is BMNR a historic value opportunity hiding in plain sight? Or is it a historic trap just awaiting the next crypto winter?
That's the question.
If this deep dive helped you connect the dots on this complex financial maneuver, please hit the like button and subscribe to Stock Analytics AI.
Remember, membership gets you instant access to 500-plus deep dives on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives for just $4.99 per month.
Thank you for joining us for the deep dive.
This analysis was generated by an AI system for educational purposes and should not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions.